This presentation is going to take a brief overview of Chapter 3 from the Kimmel text, which looks at the accounting information system. This is for financial accounting at Railroads University, and this is Lisa Ritchie speaking. Throughout this chapter and the ones that follow, we'll be progressing through this 6-step transaction recording process. The first step in this process is answering whether or not the event that we're looking at is a transaction at all. We answer that by asking ourselves the question, is the financial position, defined by the assets, liabilities, and shareholders' equity, changed by this event? We see here 3 examples: purchase of a computer, discussion of product design, and payment of rent. We can see that the middle event, discussion of product design, does not impact the financial position and is therefore not recorded or quantified on the financial statements, although it might be mentioned somewhere in the notes. Our impact can be further broken down, particularly in the shareholders' equity section, into impacts that affect common shares, revenue, expenses, and dividends. For any transaction, we'll be looking to place its components into one of these 6 buckets: assets, liabilities, common shares, revenue, expense, and dividends. The next step after we analyze the business transactions is to do what we call journalize the transactions. Before we can do that, we'll need to develop an understanding of the journal entry system, also known as double entry accounting. This will require us to understand debits and credits. We use these in reference to what we call T accounts. There's one pictured here. And in the individual journal entries, we indicate a debit by a slightly left-placed number and description, and credit by a slightly hanging indent to the right, entry and number. Rather than thinking of debit and credit as meaning left or right, debit means the left side of the account and credit means right. We total the entries on each side. If the side on the left has a higher balance, an account has a debit balance. And if the right has a higher balance, the account has a credit balance. We add these all together and have certain terminology. Debiting means entering on the left, crediting means entering on the right. The normal balance of an account is determined by the side on which it increases. This is one strategy to remember that. Using your left hand, if you raise the thumb and pinky finger, those indicate or represent the accounts that increase by debiting. This means these accounts also have normal debit balances. If you take your right hand, those 3 accounts, liabilities, owner's equity, and revenue, increase by crediting and have normal credit balances. If the hand gesture trick doesn't really work for you can look at a diagram like this, which is an expanded T account, or one similar to the expanded accounting equation pictured a few slides before this one, that breaks down and shows which accounts increase on which side. Remember, the side on which the account increases is also the side of its normal balance, or the side we expect its balance to be on in our trial balance. As an example, if a company issues common shares in exchange for cash, what we call basic analysis, which was mentioned on that very first slide in the 6 steps, is a simple verbal description of what happens when we do this. When we issue shares, our cash increases, and shareholders' equity, specifically the common shares account, also increases. Under equation analysis, we place the amounts underneath the category that they impact. So here we see cash increases $2,500 and shareholders' equity increases $2,500. This keeps our accounting equation in balance. The debit-credit analysis is eventually going to become the basis for our journal entry. Our debits will be listed to the left and show an increase to cash of $2,500. Our common shares will increase by crediting in the same amount and be written slightly over to the right. Once all of our journal entries are complete, we'll be able to create something called a trial balance. This is exactly what it sounds like, a trial or a test to see if our accounts balance. It proves the mathematical equality of the debits and credits and aids in the preparation of the financial statements. But the trial balance will not catch every single error. So you could pause here and think about it, or take time to read in the text some examples of errors which will cause the trial balance to 1. Still be in balance, and 2. No longer balance. I have some key examples on the next slide. Specifically, the trial balance will still balance if we enter amounts into the wrong accounts, if we forget to post an entry or post an entry twice, maybe we flip the debits and credits. So we credit the account we were supposed to debit, and we debit the account we were supposed to credit. It will also still balance if we make the entry to the correct accounts, but for the wrong amount. However, there are some errors that the trial balance will catch, such as if we forget one side of the entry, or if we enter the wrong number on only one side of the entry, but the correct number on the other. Most accounting systems will prevent these kinds of obvious errors, as they'll recognize that the error will cause a trial balance to be out of balance. However, in your own practice of completing questions, we can at times make these sorts of errors.